Hey everyone, this is Andy Michael with Seven Springs Wealth Group. With a lot of news in markets recently, I think it's a great time to step back and talk about how we want to be thinking about investing through cycles. As we can see here through this chart, market cycles are very, very normal. This is just a very simple explanation of the business cycle. We have expansions, peaks, contractions, and troughs. That's what makes up the business cycle. So inevitably, we're in one of those points where we're having a contraction. You may have seen that we just had a negative real GDP print for the second quarter. We've now had two consecutive quarters of that, which would define a traditional definition of a recession. But here's what you need to know about this. Number one, this is not the financial crisis. You can see what the financial crisis looked like back in 2008, 2009. We had very, very severe drawdowns. Here we're talking about negative 1% contractions over the past two quarters. Very, very different. Number two, we've had a very high hurdle rate over the past year. In 2021, we had growth of 5 to 6%. That's very different than what we were having over the last 10 years pre-pandemic, where we just had this very slow, steady Eddie 2% growth. When you have a 5% growth, that's a much higher hurdle rate. So you take a 5% growth, a 1% contraction, that's 4% growth over 2 years. Kind of sounds like 2% growth to me. So we're still on the same type of trajectory that we were on before. It's just come with a little bit higher peaks and a little bit lower valleys than what we were seeing over the last 10 years. And finally, we still had very positive nominal growth. So actual growth was at about 8%. It's just we've had inflation at 9%. That's what leads to that negative 1% real GDP print. But if you're having 8% growth, that's still an environment in which companies can grow earnings. People have jobs. So again, still a lot of positive momentum, even though you're seeing a real GDP print of a couple of negative quarters, which again is a normal part of the cycle. So let's talk about markets. By markets, by definition, we've had a 20% decline, which would be considered a bear market. But here's what you need to know about that. Double-digit drawdowns are normal. Look at all these years since 1980. Nearly every single year has a drawdown of double digits. So that is, again, a normal function of a market. In fact, markets typically go 3 steps forward and 1 step back. They've been positive 32 of the past 42 years. So that's roughly up 3, down 1. What's happened in the past 3 years? We had three years in a row of double-digit gains and 1 year of drawdown, which is what we've seen so far this year. It's very rare, what you can see here, it's very rare for a market to be up single digits in a year. In fact, it's more rare than even for the market to be down in a year. So to get those 8-10% annual returns in the market, you got to go up double digits 2 or 3 years and down in order to smooth out that ride to get those 8 to 10% long-term returns. So again, a normal function of market cycles. So what are our takeaways for today? Cycles are normal. Business cycles, market cycles. You can see real GDP growth moves up and to the right. Sometimes the line goes down. Those are normal market cycles. Or business cycles. We just saw it with market cycles in the past chart. But markets offer real return on investment. If you were just to buy the S&P 500 in 2012, you've collected $105 a share. 10 years later, you're now collecting $208 and now $229 expected for 2022 per share. In the meantime, you would have collected all of the earnings that took place and dividends that paid out in that time. So that means you generated a real return on that investment through all sorts of business and market cycles and through political cycles, and there's inflation and pandemics and wars all tied into those past 10 years. So what that leads us to do is to be an investor, not be a trader. Investors know that the cycles are a normal function of how markets work. Traders are trying to guess at what point we are in that cycle and what they can do about it over the next 3 to 6 months. So interest rates, inflation, the Fed, even recessions are all short-term in the nature of being a long-term investor and collecting these earnings and having these earnings grow and generating that real return on investment. That also means then that drawdowns are not a loss. We just saw it in the last slide. We know we're going to have drawdowns as part of the market. It is a normal piece of the market. It's a normal part of the cycle. So don't overly fret when you have those drawdowns because we know it's going to happen. And so long as we stay invested and we continue to collect these earnings and these earnings continue to grow over time, we know that that drawdown won't be a permanent loss. Finally, not a market, be an opportunity timer. So we can't control what the market's doing. We can control what we're doing in the market. Very distinct difference there. And so when we're going to have an opportunity like now to get this same trajectory here, but all of a sudden get it at a 20% discount from where we could get it 6 months ago, that is an opportunity to put long-term investment capital to work. Conversely, when we do have markets at all-time highs and say an investor is in the deaccumulation phase of their lives, there will be opportunities to take a little bit of gain off the table, to rebalance the portfolio, de-risk a little bit. So we want to be opportunistic throughout market cycles because we know those market cycles occur. We just simply can't be market timers to try to time them. It's nearly impossible. So I hope this is helpful. I hope this explains a little bit about how we view investing in market cycles. If you have any questions, please reach out to us, and we look forward to seeing everyone here again soon. Take care.